Welcome to Upticks. I'm Jake Falcon, the founder of Falcon Wealth Advisors and your host of Upticks. Today is episode 124, 2021 Market Predictions. Cory, welcome back to the show.
Thanks for having me. Feels good to be back.
I know that you hate that term market predictions. That's why I named this episode of that, just for you.
Oh, thank you. That's very considerate.
Well, before Cory and I dive in, we hope all of you out there are staying safe and healthy during this horrible pandemic. And you might be wondering why I was flashing up a deck of cards in the intro here. And you'll have to stay tuned, and I'll show you why here in a moment. It's not a card trick, though. I should probably learn one of those, though.
I don't know any.
Yeah, I feel like I learn them and then I forget them.
Yeah.
Now, before we dive into our 2021 market predictions, I think it would be amiss not to talk about what in the world happened in 2020, excuse me. So happy New Year, everyone. This will be rolling out as we enter in 2021. And Cory, why don't we give a quick recap as to what in the world happened in the market and around the globe in 2020. So I guess we finished off 2019 with the market up around 30%. Is that right?
Close to it.
And January to start 2020 was another good month. So the stock chart, kind of shot up in 2019. And then in 2020, it continued that momentum. The Chiefs won the Super Bowl. I was there.
It was like a lifetime ago.
I know. I was down in Miami with Rachel. Chiefs won the Super Bowl. It was an awesome game. Embarrassing fun fact, we almost left, believe it or not. I never would have lived that one down.
No, you wouldn't have.
Did you watch it?
Of course.
Where'd you watch the Super Bowl?
With my in-laws.
Guys, so they had a little party?
Mm-hmm.
Back when you could do parties and not worry about COVID.
Yeah, when life was simpler. But yes.
So I don't know. What was it? The third quarter, the Chiefs didn't have very much momentum.
Fourth quarter.
Was it the fourth quarter?
Fourth quarter, yeah.
You're right then. I literally think I looked at Rachel and said, maybe we'll give them one more series. Literally. And the Chiefs scored or something happened and we stayed. Crazy as it was. Of course, I'm thrilled that we stayed to watch one of the best games I've ever seen. But it was a nightmare getting out of that stadium. I don't know if I told you that, Cory. I probably did. All the Ubers were gone. All the cabs gone. And they had no plan. And so basically,
was it just a free-for-all?
It was bad. It was bad. And there was hundreds, if not maybe thousands of people stranded in the parking lot. And finally, they came up with this idea to bus all of us that could fit to an airport. So it was like, I don't know, midnight, 1 o'clock in the morning.
Yeah, probably later.
Yeah. They bussed us to an airport where then we had to order our own Uber to get back to our hotel. So it was a nightmare.
If you're looking for sympathy, you're going to have to look elsewhere. I don't think you're going to find it from me because
good point. But it was anyways. All right. So that happened. And then COVID swept the world. Why don't you go into February, March, April, what happened next?
Yeah, well, and I think I just want to point out too, it's basically we're ending 2020 similar to how we started with the market, basically flirting with all-time highs. But we had a 35% crash in between that. That was spurred by a pandemic that started in Asia, spread beyond Asia to Europe, ultimately to the United States and the rest of the world. We endured in February and March, the economic shutdowns, basically globally, which created all kinds of consequences and presumably will have ramifications into the future. But that's really, I think, what we had to do because people had no idea what it was that they were dealing with.
Right. So COVID swept across the states. Yep. Market was down, like you said, 30 to 35% basically in a month, right? Basically February and March were awful.
Yeah. In fact, I know there's the dates are, I think it's the 23rd of February to the 23rd of March. The intraday move in the market was over 35%. So in a 1 month period, that is the worst 1 month on record.
Wow.
And March, for what it's worth, it was the most volatile month in the stock market ever. The average move in the S&P 500 in March of 2020, the average move was 5% a day.
Wow. Crazy. All right. So unemployment spiked, GDP tanked, businesses are shut down.
Yep.
Basically, travel ceased to exist. I mean, there's a chart of average daily flights that just went down to nothing.
Falls off a cliff.
Everything stopped. Everything shut down. And we sat tight, and slowly this thing started to grind up, back into the summer, into the fall. And maybe you can comment on why did the market go up if we were still in a pandemic in the summer and the fall?
I think policy response was a big part of it. So the Federal Reserve and the Treasury and Congress, to some extent, there was, of course, the fiscal stimulus from Congress, where money was sent to individuals, which is up to debate how successful that was or wasn't. But as far as the markets go, basically the Federal Reserve stepped in mid to late March and said, we'll provide the backstop, we'll provide the liquidity. We're basically not going to let this hit the fan. We're going to do what we can to keep things liquid and keep things moving. And I think, as critical or as cynical as I might be about politics and the government sometimes, I think that they did a great job stepping in when they did, and, and reassuring people, because if we look back at the financial crisis in 2008, the housing crisis, the fact of the matter is there was too much waffling over what to do. And by the time they did something, it was far too late. This go round, they jumped in and interjected and, took action immediately.
Right. And to firm that up a little. So what they did is they lowered interest rates.
Yep.
They actually started buying bonds, which basically meant that the bond market kept liquidity, which is a big deal. So when you have financial crises, you don't want liquidity to freeze, because then everybody panics. So just imagine if your bank said they're not open and you can't, it's like isn't that It's a Wonderful Life when, the bank shuts and can't. So that's what they did. Basically, they pumped money into the system to keep the system going.
Yep.
Then we had the PPP money that came out and rolled through for small businesses. So, and individuals received checks if your income was under a certain amount. So you got cash in your account, lowered interest rates, they bought bonds, and then for small business owners that qualified, they got PPP money to keep people employed, was the whole premise of that.
Jake, and then something really amazing happened. And, in true fashion is who we are as Americans. We started spending money because people weren't traveling. People weren't going to bars and restaurants. They weren't spending money on all the stuff they were used to spending money on. So they started, doing remodels at their house. We've seen some of the, technology companies, some of the more like lifestyle brands. People have been spending a ton of money. In fact, through, if you look at consumer spending and more specifically personal savings through the third quarter of this year, I don't think we have the data through the fourth quarter. Personal savings, so basically the average savings of an American this year was actually higher through the third quarter than it was at the beginning of the year, despite the pandemic and everything that happened.
Well, nobody's spending, nobody's going anywhere.
Exactly.
Well, you can't spend money. You can't, we canceled our trip. We were going to go to Europe. We canceled that. There's nothing you can do. So, trying to get that glare off. So, it doesn't look bad though, does it, Cory?
No, not bad at all.
So, you can't spend any money, and that's why savings.
We just found new ways to spend it. We found new places to spend it.
Good point.
The fact of the matter is the GDP of the economy and the performance of the S&P 500 and the stock market, the two are very different, right? And the consumption base of those is different. The service base of those is different. So there have been all kinds of companies that were set up to thrive in this type of environment.
Right. So good. So that's what happened in the summer and, fall. So again, the Fed stepped up, we got money into the system. And then we had businesses start to reopen, right? So, and again, it's important to remember the market is not about good or bad. It's about less good or less bad or more bad, or whatever. So as we started to open back up, companies, like you said, some companies have thrived during this environment and they've made money, particularly the tech sector has done very well this year. And that drove the market up. So as of the recording of this, we're not quite done with 2020, but it looks like the S&P is going to end the year somewhere around up 14% or so, which is great, which is above average. The average is 8 or 9. Okay, good. So that gets us, I don't want to spend too much time on what happened, because the reason people are tuning into this episode is they want to know what is our prediction for 2021. And I don't have a magic 8 ball. Maybe I need to get one of those or a crystal ball in here. So the deck of cards I was going to suggest, Cory, pick a card, any card, right? I mean, there's so many different things, outcomes that could happen for 2021. And then you're getting all these gurus out there with their predictions. And I laugh, and I think you might have the numbers on this, maybe you don't, but I laugh because a lot of people are out there projecting 8 or 9% returns, which is roughly the stock market average. But ironically enough, it almost never makes that in 1 year. So by guessing that you're going to make 8 or 9%, you're pretty much locking in that you're going to get it wrong, because it hardly ever gets 8 or 9% on the button every year. You might as well go higher or lower if you're going to make a guess. But what do you, I mean, I know you read a lot about this stuff and you and I follow the markets very closely. What are you predicting? Let's first talk stocks and then talk bonds.
Okay. Well, first, let me say one quick thing, Jake, about the predictions, right? And because I just talked about this on a podcast and a video that I recorded for my show in the Money Insight.
Humble plug. So let's plug your podcast.
You like that? I had to make sure that I worked that in there. What I was going to say though is
the glare.
The average, analyst expected return for 2020 was somewhere, but it was between, it kind of depends on where you look, and because there's different surveys, but it was between like 2 to 5% was the average expected return. And then, like you said, we're up 14%. It's like if we knew that snow was coming and the meteorologist says it's going to be 2 to 4 inches, and then we get 14 or 15 inches. Like, that's a pretty big swing and a miss. Not that anybody could have predicted the pandemic, but the whole point being that, again, people put a lot of stock in that, but I don't necessarily know why. But as far as 2021 goes, I have no idea. I don't know any more than the next person does. I'm not going to say I expect the market to make 8 or 9%, because you just said if I do that, I'll probably be almost locking myself into being wrong. But I would venture to guess that, next year, I would say, if I had to make a prediction, I would expect maybe the market's return to be maybe a little bit below average. I'd expect it to be positive, but up. The reason I think that is because I think what we've seen over the last few months here, basically since election day, the market has almost gone straight up. If I had to make a prediction, my estimation would be that maybe we've pulled some of next year's returns forward into the fourth quarter of this year. And that's why we've seen the market do so well this year.
So you actually made a little bit of a prediction, which I didn't expect you to do.
Again, I don't want to just say, I think the market will end on 12/31 of 2021, right? Like, I think the market's going to close on December 31st. Of course it's going to. If I had to put a guess on it, that would be it.
Gotcha. And thank you for those comments. And sorry, my water dropped here. I didn't want to interrupt what you were doing.
That's all right. What do you think?
Well, okay. So you're right. I think the tech sector has done extremely well and led the market. And I think it's long in the tooth. And so I think small caps are going to do well. And I think international has potential to finally do well.
Yep.
Especially if we get the dollar weakening, which could happen, right? With all of this, stimulus money pumping in, or any way that you want to look at it. So, I don't know about above average or below average, but what I do know from a portfolio perspective, what we've decided is that we are going to take even more of an equal weight stance than we did. So, and we forgot on our recap, the election, right? So I guess I
know. I didn't want to waste any more time not waste time, but I didn't want to talk about the recap anymore. But yeah, the election.
Yeah, maybe people are tired of this, but yeah, big event, obviously, big election. Looks like, Biden will be president. As of the airing of this, we're still waiting on Georgia, but we got through that also. And a quick side note, the market likes gridlock. And so ultimately, if Biden is the president, as long as the Republicans can keep the Senate, or frankly, or even close to the majority, I think a lot of the Democrats in the Senate have come out and said, hey, we're not going to vote on this new Green Deal and all this stuff. Yep. Like, we're not going to get extreme with it either. That's why also you've seen the market rally, because we feel like there's going to be gridlock, which is good. Believe it or not, it's good. In the market. I know it's frustrating because we're waiting on bills to get passed, and maybe some changes that need to be made aren't being made. But from an economic and market perspective, I think it's a good thing. So again, I think it's time for some of those underperforming asset classes will potentially emerge. I think value might do better. I think small caps might do better. And I think international might do better. Are we going to make a big bet and overweight any of those? Absolutely not. But we are going to take more of a neutral, equal weight stance. Keep with our diversification strategy. We are revamping our portfolio starting in January. So we're going to make some shifts. So if you're tuning into this, expect to see some activity in your accounts. Again, we don't charge commissions when we do this. We're just setting up the portfolio for what we think could be a bumpy ride in 2021, There's still a lot of uncertainty of how effective the vaccine is going to be. There's some uncertainty on the political front. So again, I think technology probably still will do well, but I don't want to be so overweight in technology that if it doesn't do well for whatever reason and it underperforms, that we're not caught lagging everything else. If that makes sense. So that's what we're doing on the stock side, is that we're going to keep those colored boxes that we always do, and rebalance and reallocate appropriately. We're just going to equally weight our sectors a little bit more, so that we're not caught off guard if one sector outperforms another.
Yep, that's good. It makes a lot of sense. And I think, exactly to your point, that we've started to see, a rotation from those big tech companies to, Value International, et cetera, just over the last month or two. I think it'll be fascinating to see how that plays out next year too, because my expectation is aligned with yours, that we might see more of the unloved sectors from the last few years perform better than the sectors that everyone's piled into.
Right. And as far as the bond market, I mean, the 10-year treasury yield is still under 1%. There's been a lot of people suggesting that could drift higher. That'd be a good thing for savers, by the way. A bad thing if you own a bond fund in your 401k.
Right.
So be careful of that. We don't use bond mutual funds or ETFs at Falcon Wealth Advisors. So if you're in a bond fund with your current advisor or in your 401k, please reach out to us, because I don't think you should be in those. I think if rates go up, the bond funds could go down in value and hurt your portfolio. So I think it's very dangerous. I think it's even more important that you're picking individual bonds, preferred stocks, dividend paying stocks, and managing the fixed income side of the portfolio appropriately.
Yep. Can I give you a bold prediction for the bond market?
Yeah, let's hear it.
All right. So I was just reading this morning, it might've been yesterday morning, actually, a report from one of our institutional research partners. And it talked about how there was 58 different analysts that were surveyed on where they think the yield on the 10-year bond will be at the end of 2021. So currently it's around, 95 basis points or 0.95%. Only 4 of those 58 said the yield would be higher than 1.5%. So as a contrarian, I'll say, I think that the yield on the 10-year bond will be higher than 1.5% at the end of 2021.
Was that Strategas?
It was.
I was reading the same thing. That's pretty funny. Yeah, their argument was that, it could 2% could be the big deal that no one's thinking about.
Yep.
We'll see. And why does that matter, Cory? Why don't you explain real quick before we wrap up here? Why does that matter? Why does the bond market and the yield matter to our clients? There's two reasons.
So for clients that basically, if we're going and buying bonds for clients, right, is more the stable or fixed side of their portfolio, higher interest rates mean that they can earn more income, or they can earn more interest on the bonds that they're buying, which is actually not a bad thing. And also higher longer term interest rates, like 10 years, the Federal Reserve doesn't have control over those. That typically, interest rates will move higher when they're expecting further economic growth down the road. So again, it's not necessarily a bad thing, but with rates as low as they've been, the fact of the matter is, if we're going and buying treasuries or corporate bonds or whatever it is, we're in a spot where we really have to search far and wide to find interest rates that are basically worth even investing in to begin with, because rates are so low. Or if people just have money in a money market or a savings account, I mean, those accounts pay more interest when interest rates are higher.
Right. And don't they say that the secret is in the bond market? I mean, if you really want to know what the stock market's going to do, you look at the bond market. Yes. And like you said, so if bond prices go down, that means interest rates go up.
Yes.
So is that suggesting that, quote unquote, the smart money are selling bonds, maybe driving that price down, and buying stocks because they think there's more opportunity there? So when you see the 10-year treasury yield go down, that's because there's a lot of fear in the marketplace and people are buying bonds, driving the price up. Is that what you're getting at there?
Exactly. And to your point about, smart money, the whole idea is, the yield curve inverted and long-term rates started basically falling off a cliff right before COVID, which again is just interesting that, again, this most recent crash in February and March of this year, if you go and look at interest rates prior to that, exactly what you just described was happening in advance. So it's pretty interesting to see that something like that, in some ways was, I don't know if predicted is the right word, but the market.
That's the topic of the show. It's the name of the show.
Yep. The market was telling us something.
That when it inverted, that it was going to be bumpy.
Yes. And then we just saw the 10-year yield just fell off a cliff, like right before the market started to crash.
Right. Right. So again, that's one of the reasons we pay close attention to those things as well for our clients. Good. So I guess the takeaway here is your prediction is that we possibly have seen 2 years in a row now of above average returns. So you would expect maybe something below average for next year. You wouldn't be surprised by that.
If it was 4 or 5%, that wouldn't shock me.
Right. And I'm expecting
20 or down 10, I wouldn't be shocked either, but for what it's worth.
Right. And I'm expecting that maybe technology might not be the leader in the markets again. And that's one of the reasons that we're not going to get out of equities. If they have a below average return, that's okay. The beauty with our clients is we already have those below average returns built into their financial plans. So you don't worry about this. You don't need to time the market or get all in or get all out, be nervous about that. We're just saying this is what we think could happen. This is how we're making what we feel are informed decisions around that. And we'll keep you posted and keep watching it. Something new for our clients, quick heads up as we wrap up here. Something new is we're going to start sending out quarterly trade summaries on the activity that we've done for everybody, along with our market outlook, so that you won't have to wait to review to go over that. So we're going to start sending that out to you every quarter via email. So certainly that'll be only exclusive to clients of Falcon Wealth Advisors. We're not going to put that out there in the public. So if you want intel on that information, sorry, you have to be a client to get it because it is exactly the activity that we are doing and client specific here at Falcon Wealth Advisors. So perfect. So we'll wrap up, Cory. This has been a little longer episode than usual. Do you have any fun facts or anything you want to share? Any good shows? Just a quick thing. You and Cassie been doing anything? Got anything for me?
Not really.
Nothing?
Not very exciting recently.
Aren't you redoing your backyard?
That's the plan for the spring.
Oh, that's back in the spring. All right.
Yep.
And I know you had some
What
sewage
about you?
issues. I know you had some sewage issues. Welcome to home ownership.
Yeah, plumbing. 81-year-old house. Lots of fun.
Yeah.
Lesson learned. Love the house, but lessons learned.
And I've been spoiled lately. I've gotten to play some golf, which is very bonus for me. Normally, I shut it down around Thanksgiving, and I got to play in December. So that was pretty cool. So Rachel and I are doing some home remodeling, just like everybody else, I think.
Yep.
Some custom bookshelves put in, painting our great room, painting our dining room, and we bought some new furniture at Restoration Hardware. I think it's some pretty nice stuff over there. So she picked out a couple couches that we're going to put in our great room, which I'm really excited about.
They do have nice stuff there.
So perfect. So thank you again for tuning in. I'm out there on not all of them, but I'm out there on social media platforms such as Instagram, Twitter, Facebook, and LinkedIn. My email address is jake@falconwealthadvisors.com. Our team is out there on those social media platforms as well. Cory, I know a lot of our clients are connected to both of us, but do you want to share your information as well?
Sure. Yeah. You could find me on Facebook or LinkedIn just by searching for my name, Cory Bittner. But I'm also on Instagram and Twitter, and my handle is the same on those two. It's @CoryBittnerKC. My email address is just Cory@FalconWealthAdvisors.com.
Perfect. Thank you again for tuning in, and we hope all of you have a happy new year and a great week.